Welcome, trader. This is Steven with TMT. No pain, all gain. Now let's trade some knowledge. Stock trading. Just prefixing the word trade with stock can immediately veer people into treating it differently than all other types of trade. Almost like it's some kind of superior mythical asset class that's not subject to the simplicity and commonality of trade in general. In reality, a stock trade is similar to other types of trade in that it involves three main things: a buyer, a seller, and the middleman, the market maker. Let's start with the buyer. The buyer offers a specific amount of cash to the seller to buy their stock. This offer is known as their bid price. On the other end of the trade, the seller asks for a specific amount of cash that they'd be willing to sell their stock for. This is known as the asking price. The bid price and the asking price don't always match, but when they do, a trade can be executed. However, there can be many buyers of the same stock with varying bid prices, and there can be many sellers with varying asking prices. If only there were some entity that could make sense of all these bid and ask prices, and even more so, determine a market price which produces the most trades and is also able to execute the trades on the buyers and sellers' behalf without delay. Enter the market maker. The market maker is a person who works in the stock exchange, and their job is to provide liquidity in the markets. This involves setting a market price for a given stock, executing trades for their customers, and providing a seamless transaction. This service, however, comes at a cost, which is passed along to buyers and sellers when they go to make a trade. To accomplish this, the market maker creates their own bid and ask price centered around the market price. This is known as a spread. Buyers now buy at the market maker's asking price, and sellers now sell at the market maker's bid price. The difference, or spread, is the market maker's profit for a single buy and sell transaction at that moment in time. A tight spread occurs when the difference between the bid and ask is small. This is most prevalent during times of low volatility, high liquidity, and when buy and sell orders are abundant and relatively balanced. This is typical of a normal trading day. A wide spread is when the bid and ask price are far apart. This occurs during times of high volatility and low liquidity, when there's a substantial imbalance between buyers and sellers. This is most common during an earnings release, or even more extreme, a stock market crash when sellers overwhelm the market and buyers are nowhere to be found. Market makers stand to make a significant amount of money during these times, since spreads are at their greatest and there is a large volume of trades being executed. The market maker will usually hold an inventory of stock so they'll be able to execute trades at will, no matter the volatility. This enables them to provide liquidity in the market at any time. Traders are able to view the volume of buy and sell orders at the bid and ask prices by looking at the size of the orders. The size is presented in lots of 100 shares. For example, a size of 5x6 would mean that the market maker is looking to buy 500 shares at the bid price and sell 600 shares at the asking price. This would represent a stock trading at close to equilibrium, where buyers and sellers are evenly matched. During volatile times, that spread may be more along the lines of 1/10. This would signify a large volume of sellers and very few buyers at the quoted price. The market maker will then lower the price of the stock until more buyers are found and an equilibrium can be reached again. Although there is a lot going on behind the scenes, the process is designed to make trading easy, convenient, and instantaneous for the customer. What may sound like a good thing can actually be detrimental. The ability to make real-time trades fuels the fire for impulsive traders that act on emotion rather than logic and analysis. Being able to resist such temptations is a significant breakthrough for new traders, and a huge step towards becoming the modern trader.